Welcome back. This video is about the constant dividend growth model. We have 4 other videos. We have a video about the dividend discount model, which is video number 1. This is the second one you're looking at. The third one is about changing growth rates, total payout, and in the last video I'm going to give a summary. The constant dividend growth model assumes that dividends grow at a constant expected rate, which we call G. In that case, G is also the expected capital gain rate. The growth is captured in the following equation. The price of the stock depends on the current dividend level, the cost of equity, and the growth rate. And in this equation, we have broken down the cost of equity into dividend yield plus G, and G stands for capital gain rate. Let's have a look at example number 3. Suppose we have Eneco, which is a regulated utility company servicing the Amsterdam area. And suppose they plan to pay €2.30 per share in dividends in the coming year. If its equity cost of capital is 7% and dividends are expected to grow by 2% per year in the future, estimate the value of Eneco's stock. Good luck. Here are the answers of example 3. If dividends are expected to grow at a rate of 2% per year until the infinity, we can use the previous equation to calculate the price of Eneco's stock. We have a dividend of €2.30. We have a cost of equity of 7% and a growth rate of 2%. That gives us a stock price at T0 of €46. Let's have a look at another example, example number 4. US Telecom plans to pay $1.44 per share in dividends in the coming year. Equity cost of capital is 8% and the growth rate is 4% until the infinity. Estimate the value of its stock. Good luck. The answer of example 4 is the price of US Telecom is driven by the size of its future dividend, which is $1.44, its cost of equity and its growth rate. And as a result, the stock price at T0 is $36. Let's have a look at another example, number 5, about using information in market prices. Suppose BMW will pay a dividend this year of €5 per share. Its equity cost of capital is 10%, and you expect its dividends to grow at a rate of about 4% per year, though you're somewhat unsure of the precise growth rate. If BMW stock is currently trading for €76.92 per share, how would you update your beliefs about its dividend growth rate? Is there upside or downside? Good luck. Have a look at the answers of example 5. If we apply the constant dividend growth model based on a growth rate of 4%, we would estimate a stock price of €83.33. The market price of €76.92, however, implies that most investors expect dividends to grow at a somewhat slower rate. If we continue to assume a constant growth rate, we can solve for the growth rate consistent with the current market price using the previous equations. If we do that, we will need to fill in a cost of equity of 10%, a dividend of €5, and a current stock price of €76.92. That will give us a growth rate of 3.5%. Thus, as a conclusion, given this market price for the stock, we should lower our expectations for the dividend growth rate, unless we have very strong reasons to trust our own estimate. Now, this slide is telling us that future dividends depend on earnings, shares outstanding, and if we divide earnings by shares outstanding, we will get the earnings per share, and the dividend payout rate. Now, assuming the number of shares outstanding is constant, the firm can do two things to increase its dividend. You can either increase your earnings or you can increase your dividend payout rate. So both will lead to a higher amount of dividend paid to the investors. In the dividend discount model, earnings play an important role. Now, a firm can do one of two things with its earnings. It can either pay the earnings out to investors, or it can retain the earnings and reinvest it in the firm. Now, the dividend discount model with growth assumes that earnings can only change as a result of new investment from retained earnings and the return on that new investment. The definition of new investment is the retained earnings times the retention rate. So it's that part of the retained earnings that you keep in the organization and reinvest in the business. Now, if the dividend payout rate and the number of shares outstanding is constant, and if earnings change only as a result of new investment from retained earnings, then the growth rate of the firm's earnings, dividends and share price is calculated using the following equation. So that means that the earnings will grow at a rate that is equal to the retention rate multiplied with the return on new investment. So we've learned from the previous slides that the stock price depends on the size of the investment and the return on the new investment. So if a firm wants to increase its share price, should it cut its dividend and invest more, or should it cut investment and increase its dividend? The answer will depend on the profitability of the firm's investments. Cutting the firm's dividend to increase investment will raise the stock price if and only if the new investments have a positive NPV. Let's have a look at example 6. Nike expects to have earnings per share of €6 in the coming year. Rather than reinvest these earnings and grow, the firm plans to pay out all of its earnings as dividend. With these expectations of no growth, Nike's current share price is €60. Suppose Nike could cut its dividend payout rate to 75% for the foreseeable future and use the retained earnings to open new stores. The return on its investment in these stores is expected to be 12%. Assuming its equity cost of capital is unchanged, what effect would this new policy have on Nike's stock price? Good luck. Let's look at the answers of example 6. First, let's estimate Nike's equity cost of capital using the equation in the previous slides. Currently, Nike plans to pay a dividend equal to its earnings of €6 per share. Given a share price of €60, Nike's dividend yield is 10%. With no expected growth, the cost of equity of Nike is in total 10%. In other words, to justify Nike's stock price under its current policy, the expected return of other stocks in the market with equivalent risk must be 10%. Next, we consider the consequences of the new policy. If Nike reduces its dividend payout rate to 75%, then this coming year its dividend will fall to €4.50. That is equal to €6 times 75%. At the same time, because the firm will now retain 25% of its earnings to invest in new stores, the growth rate will increase to 3%. Assuming Nike can continue to grow at this rate of 3%, we can compute its share price under the new policy using the constant dividend growth model. Here we see that the first dividend payment is €4.50, the cost of equity is 10%, the growth rate is 3%, and that gives us a stock price at T0 of €64.29. We conclude that Nike's share price should rise from €60 to €64.29 if it cuts its dividend to increase investment and growth, implying the investment has a positive NPV. And the NPV per share in this case is €64.29, less 60 gives you €4.29 per share. Let's have a look at the last example of this video, number 7. Suppose Nike, from the previous example, decides to cut its dividend payout rate to 75% to invest in new stores, as in the previous example. But now suppose that the return on these new investments is 8% rather than 12%. Given its expected earnings per share this year of €6 and its equity cost of capital of 10%, what will happen to Nike's current share price in this case? Good luck. Let's have a look at the answers of example 7. Just as in a previous case, Nike's dividend will fall to €4.50. Its growth rate under the new policy, given the lower return on new investment, will now be 2%. The new share price is therefore €56.25. So we conclude that even though Nike will grow under the new policy, the new investments have a negative NPV and its share price will fall if it cuts its dividend to make new investments with a return of only 8%. We have come to the end of this video. I would like you to open the next one, which is called Changing Growth Rates. Thank you.